The recent bull market was so significant that investors who had a financial advisor and lost money during that bull market rather than financial gains have reason to consider whether they have a cause of action against their broker or financial advisor. The bull market of the most recent decade began on March 9, 2009, after the stock market bottomed out following the Great Recession. The bull market ended on October 12, 2022, when the S&P 500 closed more than 20% below its peak on January 3, 2022. This was the longest on record, lasting for 13 years and 237 days. It was also one of the most robust, with the S&P 500 more than tripling during that time. The bull market was fueled by a number of factors, including the Federal Reserve's aggressive monetary policy, which included quantitative easing and low interest rates, the strong corporate earnings growth that followed the Great Recession, and the rise of new technologies such as smartphones and social media. However, the bull market began to falter in 2022 due to a number of factors, including the Federal Reserve's decision to raise interest rates in an effort to combat inflation, the war in Ukraine and its impact on global supply chains, and rising concerns about a recession. Claims for investment losses are usually subject to mandatory arbitration before the Financial Industry Regulatory Authority, or FINRA, whose rules and procedures of FINRA are different than traditional lawsuits and are resolved through arbitration. Arbitration is generally quicker and less formal than a courtroom trial. An investor fraud case is usually resolved by a panel of 3 arbitrators appointed by FINRA instead of a judge. These arbitrators will preside over hearings during which both sides may offer testimony to support their claims or defenses. The arbitration panel then usually issues its decision within 30 days of the final hearing. The average FINRA arbitration takes approximately 14 months to complete, which can be much quicker than the average court case is resolved. FINRA also offers a simplified arbitration in disputes seeking damages of less than $50,000. Simplified arbitrations are presided over a single arbitrator and are typically resolved quicker than regular arbitrations. Financial advisors should not make an investment recommendation without first understanding the client's investment objectives and risk tolerance. In addition, financial advisors have a duty to disclose all material information regarding a recommended investment and explain the risks associated with it. If your advisor breached these duties, you have a potential claim for money damages. Common types of securities fraud and broker misconduct include churning. Churning occurs when a stockbroker recommends frequent trading solely for the purpose of generating commissions. Unsuitability. A broker has a duty to know his or her client. Your financial advisor must discuss with you the level of risk with which you are comfortable and invest your assets accordingly. If a financial advisor recommends securities that don't meet your risk tolerances and investment objectives, and you suffer losses, you might be entitled to legal relief through a securities fraud lawsuit. Breach of fiduciary duty. A securities broker has a fiduciary duty to act in the client's best interests at all times. This duty may have been breached if your investment advisor puts his or her financial interests ahead of your financial interests. For example, if a broker sells certain mutual funds or other securities because he or she will receive a higher rate of commission than similar, better performing investments, you may have grounds to file a breach of fiduciary duty lawsuit. Overconcentration. Diversification is an important component of a successful investment portfolio. When a stockbroker fails to properly diversify your investments, leaving your account exposed to only a few securities or a single sector of the economy, you may be able to recover your losses through a securities fraud lawsuit. Unauthorized trading. In general, a stockbroker must obtain your permission before buying or selling securities on your behalf. If your broker fails to receive approval prior to executing a trade, he or she may have broken the law. Furthermore, a broker can't exceed his or her authority by receiving commissions on trades that are not suitable for a client's account. Mutual fund, bond, or annuity switching. Similar to churning, this type of securities fraud occurs when a financial advisor recommends that a client sell a particular group of mutual funds, bonds, or annuities, and then repurchases a nearly identical instrument only to generate a commission for the broker. Margin claims. Some brokers negligently recommend that customers borrow on margin to purchase securities and then require the customer to sell the securities without prior notice to pay off the margin balance. Here are some tips for documenting your claim. Gather all communications with your financial advisor, including emails, letters, and phone records. Gather any supporting documentation, such as account statements, trade confirmation, and investment prospectuses. Be prepared to explain your investment goals and risk tolerance, and whether you discuss these with your financial advisor. Be able to articulate how your advisor's actions caused you to lose money. It's important to note that losing money on your investments isn't necessarily grounds for a claim against your financial advisor. However, if you can show that your advisor's actions caused you to lose money, you may have a valid claim. If you're concerned that your financial advisors wronged you, fill out a contact form and send us a message to see if one of the law firms in the Law Center network can help you. Find the link for the contact form in the description portion of this video.